Hey everyone, welcome to 12 Steps to Financial Mission Success. It's one thing to educate yourself about managing your finances. It's another thing to know what order to put them in. Some of you are familiar with Dave Ramsey's baby steps. Dave Ramsey has an excellent way of getting people out of debt, kind of what I call the underwater level to water level. And so his baby steps are really good to follow, although there's one caveat in there in terms of the debt snowball that we'll talk about in a second. You might also be familiar with the Money Guys, the financial order of operations. I think that's great. I love those guys. I actually watch their YouTube videos. They have some wonderful resources, so check them out as well. We have at Mission Advisory Group what we call the 12 Steps to Financial Mission Success. So it's a little bit expanded. There are a couple of things that are different from some of the typical steps that you may see out there. And I'm gonna rapid fire run through these real quickly. Forgive me if I glance for a second at notes because I wanna make sure I give you as much information as I can in quick order to run through these. So these are gonna be provided in an infographic that we're gonna put on the website. And it is the basis for an educational call that we're doing with the Ohio State University Alumni Association. And we're going to expand that to some other channels as well and other organizations to do the same thing. So here we go. Number one off the top, do not pass go, do not collect $200 if you cannot do this. And that is live on less than you are earning. Big surprise, right? But a lot of people are doing this. What does that mean? It means that they're giving over levered, right? Because if you're living on less than you, or sorry, if you're living on more than you are earning, it means that you're having to find the money somewhere, which often means revolving debt, right? It often means credit cards, personal loans, and so forth. So you got to stop that right away, whatever that takes. Trimming your budget down, cash flow management, getting another job, taking a side hustle like Uber or something like that to bridge the gap until something greater. But you've got to live on less than you earn, or full stop, game over. It can't go any further than this. Number two is making sure you have enough insurance to cover your liabilities. If you're single, that's covering yourself. Obviously, if you have a family, this is going to be way more important because you're going to have to be concerned about things like life insurance. So number two is make sure that you're covering all of your liabilities, because man, that can be absolutely devastating if you have something happen and all of a sudden you're in the hole, whether it's medically or with your car or home or something else. So you want to make sure that you're protected, which leads us into number three, which is making sure that you've got enough to cover the deductibles on that insurance. A lot of people don't think about this because they want to talk about maybe cash reserves and so forth. And while the emergency money is important and it's about to come into play, we want to deal specifically with those deductibles, because sometimes people will look at that emergency cash savings and they think, man, how am I going to get there? That's a lot of money that I have to save. And then they don't end up doing it. So what we're doing is we're just plugging in something to say, look, here's a way that you can save a certain amount and it can go toward your insurance deductibles if you need them. Now, that's going to lead into step number four, which is setting aside enough in emergency cash reserves for 1 month. Okay, now that's a little bit different here at Mission Advisory Group, what we talk about versus what you might hear in the industry. We think it's a little bit daunting of a challenge to try to save up 3 months at once of cash reserves. So what we're saying is just start with a month. Now, however you build that month is going to be up to you. That's going to be through budgeting, cash flow management. Even if you got to do it day by day, maybe you take that month of cash reserves and you say, all right, what does that look like if we break it into 30 days? And let's just save a day at a time. A day turns into a week turns into 2 weeks. Pretty soon you're at a month. So that's step number four, is setting aside the first month of cash reserves. Also, we should say that while you're setting aside those cash reserves, please make the minimum payments on your high interest debt if you have it. If you have high interest debt, if you have credit cards, continue making those minimum payments. But go ahead and try to set aside a month in cash reserves while making the minimum payments, because those cash reserves could come into play in an emergency. It could be really important. Now, this is going to go into step number five. It's going to sound a little different, but it's max out your employer contribution. Why? Because it's the time value of money. You're never going to get that free money back again. So if you're working for an employer, max out that qualified plan match that your employer is giving you. So it's usually about 3% or 4%, right? Get on it, because you're never going to get that free money back. And again, there's a time value of money. You can look up that term to understand what that means. But we want you to max out those employer matches in step 5. Step 6 is going to be revisiting the cash reserve. So this is where we want to continue setting aside savings above and beyond in order to get to a 3 to 6 month emergency fund. Why do we say 3 to 6 months? It all depends on your career. It depends on how long you think it would take to replace your job. So if you were to get laid off, for example, how quickly do you think you can get yourself back into well-paying, gainful employment, right? That's going to determine whether it's a 3, 4, 5, or 6 month period that you're saving emergency cash reserves for. So along with the cash reserves over a 3, 4, 5, 6 month period, that's also going to determine how you manage cash. And that's not part of our 12 steps. That really comes into play when it comes to financial planning and investment management. But one of the things that we do with clients is we separate that cash into tranches to understand what kind of yield we're going to get and what kind of risk we can take and what the duration or the maturity is going to look like on where we invest that cash and when we make it available, i.e. liquidity. So liquidity is how quickly we can make something available. So in those cash reserves in that 3 to 6 month period, we're going to do cash management to figure out how we want to stage the assets. Number 7 is going to be increasing the amount you're paying towards your high interest debt. You all knew this was coming. You probably figured it would have come in at an earlier step, but because of liabilities, we don't put that in there earlier. And because of the time value of money, we want to max out that employer match. So number 7 is going to be increasing the amount you pay towards your high interest debt, i.e. credit cards or a personal loan if you have it. Try to take as much as you can and start socking it away. Once you have those emergency cash reserves, really start plugging away at that high interest debt. Now, there are 2 methods you can use. One is to go for the highest interest rate first. That's what we prefer because you're knocking off chunks of money off the highest interest rate. The other is the snowball method. Dave Ramsey is famous for coining that term, and it makes a lot of sense, and it really helps some people. The snowball method is where you take the smallest balance credit card and you pay it off, and then you take the payment that you were making to that smallest smallest balance credit card, and you roll it into the next smallest balance credit card. So it's called a debt snowball for a reason, because you can see where this kind of builds on itself. So when you pay off the second card, then you're going to have that second payment rolling in to pay that third card and so forth. And you just keep rolling that until your cards, your debt, your high interest debt is paid off entirely. The debt snowball method is wonderful. It really works well for some people. We just prefer paying toward the highest interest rate first. So number 7 is going to be increasing the amount you're paying toward your high interest debt. Number 8 is going to be to max out your Roth IRA and HSA contributions. All right. Roth IRA, Roth 401k, great ways to build future wealth. Look at our debt situation in this country. Look at our tax situation. Ask yourself if you think the taxes are going to be higher later or now. Most of you will say later. That's what we think too. Okay. The deal with a Roth is that you're not going to get the tax break on it now. You're not going to get the tax deduction like you would with an IRA or the pre-tax ability like you would with a 401k, but it is going to grow tax deferred. And when you take it out later, it's going to come out without you paying taxes on it. Okay. So what you're doing is with a traditional 401k or traditional IRA, you're going to pay taxes on the disbursement later at whatever that tax rate is. But with a Roth, you're not going to do that. That's why we want you to start building that Roth IRA or Roth 401k. And there are many different methods to do that. We can help you with that. Second to that also is maxing out your HSA. If you have a high deductible health plan, you may have an HSA as an option. How does this differ from an FSA? An FSA is use it or lose it. An HSA is yours. Why do we love HSAs? Because they're triple tax free. The money is going to go in pre-tax. It's going to get invested. Yes, you can invest money in an HSA into the market. It's going to grow tax deferred. And then when you take it out for medical purposes later, it's going to come out tax free. And there are lots of different things that you can use under what's considered medical purposes, including long-term care. So think about the big issue with aging, right? And long-term care, the expense of taking care of yourself or taking care of a loved one in those later years. If you were to have hospice care, or if you were to have to go to a nursing home, it can really take a big chunk out of assets. It can be a big burden on families, which is why people were picking up long-term care insurance. The problem with long-term care insurance, or LTC, are the really high premiums. And in fact, most insurance companies aren't even engaging in long-term care insurance anymore. I mean, I think it's down to like 2 or 3 providers. So the great thing about an HSA is you can put a sizable amount of money into it, basically equivalent to an IRA if you got a family, and it'll grow tax deferred, and you can take it out tax free. That's why we call it triple tax free. Goes in pre-tax, grows tax deferred, comes out tax free if you use it for medical purposes. But also the great thing is that if you don't use it for medical purposes and you want to use it for retirement purposes, you can still take it out at a later age and pay income tax on it. So step number 8 is maxing out your Roth IRA and your HSA contributions. Number 9 is going to be shifting your focus to hyper-accumulation of wealth. Now, how do we do this, and what does that mean? There are a few examples that I'm going to give. Hyper-accumulation of wealth is sort of this above and beyond stuff, right? This is when you can create a mega-backdoor Roth. We can explain to you later how you do that, or you can Google it. There's plenty of information out there on building a mega-backdoor Roth. You can channel it into advanced insurance planning. This is where you would get a life insurance policy and use it as a LIRP, LIRP, which is life insurance for retirement planning. This is where you're using cash value life or permanent life insurance. You're putting money into it. You're paying a set premium annually, and you're investing that money and growing it, essentially tax deferred, because if you take the money out and use it for retirement purposes or college planning or something of that sort, you're essentially taking it out as a loan to yourself from the insurance company. We can explain all of that later. We won't go into detail, but there's plenty of information online about it if you want to look it up. LIRP, life insurance for retirement planning. This would be considered hyper-accumulation of wealth. Another way to do it, of course, too, is just your after-tax money. So if you have brokerage accounts, if you're investing in really anything that's out there that we would normally invest in, or if you're expanding your world into other things like crypto, DeFi, whatever it might be, this is your hyper-accumulation of wealth strategy. This really ties in with step number 12 as well, where we get into hyper-diversification. But focusing on hyper-accumulation of wealth is step number 9. Number 10 is going to be focusing on prepaid future expenses such as college planning, maxing out your college planning opportunities, or possibly funding a future business. Number 11 is going to be focusing on paying off low interest debt. This would be like your student loans or your primary mortgage. Now, by all means, make the minimum payment on your student loans. We're not saying that you shouldn't be paying on your student loans in those other steps. It just means that if you're paying the minimum amount on your student loans, and it's usually a low interest situation, don't worry about maxing that out before you get to some of those other steps, because we want you to be able to create those cash reserves. We want you to be able to max out your employer match. We want you to be able to pay off the high interest debt first, accelerate your debt payoff, max out your Roth IRA choices, start into hyper-accumulation, and then focus on paying off that low interest debt. This also includes the primary mortgage. So we're not as concerned about you paying off your mortgage like some advisory firms are. They might encourage you to pay that down as quickly as you can. Yeah, it would be great to go into retirement with your home paid off. We're not really worried about that, especially at the low interest rates where most people took out their mortgage on their current home, primary residence. That's step number 11. So that leads us into step number 12, which is hyper diversification. This is going into other real assets, real estate, precious metals, again, a future business, art. There are interesting ways to do that now where you can buy fractional shares into art. Maybe it's wine or other things that you're interested in. Maybe it's, expanding into crypto, DeFi, and other types of things, or investing in well-vetted private investments if you are an accredited investor or a qualified purchaser. There are certain rules around being what's called an AI or a QP. An accredited investor generally has $1 million in investable assets and at least $200,000 in income over the last 2 years. Qualified purchasers come in at a little bit of a higher level than that. But accredited investors, this is where you get into private investments, private placements, and private equity. So hyper diversification should really only come when you have your entire financial house in order and you've got the expendable income to do this. But that would be step number 12. So again, we are going to put all this into an infographic as a visual. Those are the 12 steps to financial mission success. If you have any questions, send us an email, give us a phone call. And as always, follow us on YouTube, follow us on LinkedIn. And we hope you found this helpful. Take care.